the start of a portfolio is to make sure that you don't put all your eggs in one basket. I know it's kind of a really obvious thing, but yeah, it's called diversification, and it's diversification for a reason, because obviously if one stock goes belly up and you have 10 stocks, then you only lose 10% of your investment, and that's sort of how it works. Obviously most of the time stocks don't fully crash, but they will go up and down depending on the market. A main thing with diversification is to make sure that you pick different sectors, and also sometimes different countries, different stock exchanges, depending on what you're looking for. You may decide that the whole portfolio is going to be on the London Stock Exchange, and if that's the case, then that's not too much of a problem, because it's a relatively good market. But there are funds that also operate in other markets, so you can buy a fund on the London Stock Exchange that is in India or America, as in North America, or Japan or China. So there's different ways you can actually diversify while not actually leaving the stock exchange. Don't forget, however, though, that if there's a lot of market turmoil, even those funds will go down slightly, but it just depends on the sort of market conditions at the time. So that's the first lesson this week, which is managing risk and building a diverse portfolio. Now, you can also split things up into shares in companies and also hold a fund. A fund is where you buy a fund, and then many companies, many stocks are held within the fund, and that's a very good way of, say, if you only have £1,000 and you only want to buy one stock, then you could quite easily buy a FTSE 100 tracker, and that just tracks the FTSE 100 index. Or you could buy into a FTSE All Share index, and you would only be tracking that index, and that's good because there's many companies in that index. Whereas if you just bought a share in a company such as Royal Mail Group, then you're obviously putting all your risk just in one place, and £1,000 you put everything in there, and it may go up, may go down, but the fluctuations will be greater than if it was just in a FTSE All Share tracker. And that's the main sort of differences. Also, don't forget to diversify across markets, but we'll talk about different markets in the next video. Okay, thank you guys, bye. Bye.